Hello, with me today I have Dave Bujnowski, Portfolio Manager at the Baillie Gifford American Fund. Dave, the fund has been around for over 20 years, but can you please tell us about its objectives and how you go about getting a good outcome for shareholders?
The objective of the fund, the American Fund, is to produce long-term capital growth. Specifically, it aims to outperform the S&P 500 index by at least 1.5% after costs over any rolling 5-year period. We think this target is appropriate given our philosophy and process and long-term investment horizon, and indeed it's backed up by the 23-year track record of the fund outperforming the S&P. Now, how we go about it, it's by finding exceptional growth companies in North America, investing in them at scale in a concentrated portfolio, and holding on to them for a very long time. We are genuinely growth, genuinely long-term, and genuinely active. Now, our approach seeks to take advantage of asymmetrical equity returns. That is, the belief that over long periods of time, relatively few stocks generate the bulk of wealth creation in the market. Supporting this view is a study we often refer to by Henrik Bessenbinder of Arizona State University. He looked at market returns of roughly 25,000 stocks from 1926 to 2016 to assess whether stocks outperformed T-bills. He found that over that period of time, roughly $35 trillion of value was created by the stock market, but more central to the point, roughly half of that wealth, $17 trillion, has been generated by just 90 of the 25,000 stocks. So we aim to identify these outliers, back them, and hold them for a long period of time.
Now, the fund, it has an impressive history of outperforming its benchmark, but the past year has been something special. The fund's up 53.6% versus just under 11% for the S&P 500 index. And it's the second best performing fund in the North America sector. You just explain why the fund has performed so well.
Yeah, we tend not to think in 1 year increments, but happy to explain the performance. Broadly speaking, there's been an acceleration of some of the big trends that we were already investing behind. In some cases, this was pre-COVID. So Shopify and Tesla come to mind. They're two of our larger positions. Fundamentals for each strengthened through 2019. So Shopify, it's a platform that helps merchants sell online. It was already growing 45% during 2019, but from that level, it still managed to accelerate into year end. And now with more than 1 million merchants using the platform, it's becoming entrenched as infrastructure for more and more companies seeking to participate in the new economy. For its part, Tesla made substantial progress on 3 concerns that had weighed on the minds of many investors for years, specifically around automobile production, where its Shanghai factory opened ahead of plan, the competitive landscape, where many of the perceived threats continue to languish, and profitability. Now, of course, as the pandemic hit, during and after, our holdings had held up quite well. Not just from a share price perspective, but importantly from a fundamental one. And the reason for this is because the investment cases for the majority of companies we invest in tend to be based on innovations, business model evolutions, or disruptions that we anticipated gaining steam in the years ahead. And that if anything, the pandemic has pulled forward, strengthening many of the business cases we invest in. So examples here would include Amazon, Zoom, Wayfair, among others.
Now, during the pandemic, we've seen stocks fall sharply. Interesting to know, have you been active in the markets during that time? Did you take advantage of lower prices during the worst of the March sell-off? And if so, which stocks have you been buying and why?
In March, it was largely business as usual, process-wise inside the team. The words I'd use to describe the mindset of our group when the pandemic hit was measured and calm. And I think that's really important to stress. As a firm, Baillie Gifford has invested in companies for over 100 years. So we've been tested before in turbulent times. And when COVID-19 came, as emotion and fear gripped the market, we traded very little, but instead focused on our process. And specifically, when both the economy and the capital markets looked to be unraveling in March, the first thing we did was stress test the resiliency of our holdings from a balance sheet and cash flow perspective. We then assessed the forward-looking hypotheses for each position, given the potential threats that came with COVID. And we were encouraged by what we saw on both those studies. Now, that didn't trigger any incremental buying at the bottom. So in that sense, no, we didn't take advantage of the March lows. But the process did help us sit on our hands during those volatile times. And this has disproportionately helped us as the markets have recovered. Now, more recently, we have been more active. But again, it's in keeping with our normal process. So stocks that we have been buying, as ever, we're drawn to situations where there's a business with an enduring edge that's very early in disrupting a large market. So examples here would include Carvana and Vroom. They are disrupting the used car buying process with an online model in the US. Or Lemonade, bringing a highly innovative AI-driven business model to the insurance industry. Some others, software companies that are particularly well positioned as enterprises shift to the cloud. Among these, Cloudflare, Datadog, and Twilio. These have been some of our recent additions.
Dave, you're heavily exposed to the tech sector, so you are clearly backing your companies to do well. But this has been something different. It's stratospheric. Share price surges. Did this level of tech boom take you by surprise?
I think every year since I've been doing this has brought its own form of surprises. But yes, this year has been particularly acute. And that's why I think it's more important than ever to stay true to a philosophy you believe in, be disciplined to your process, and then stay focused on the fundamentals of the businesses that you invest in instead of getting distracted by sometimes very emotional and frenetic stock market that brings surprises. So with that said, relative to the fundamentals, coming into this year, did I expect Shopify to accelerate to 97% year-over-year growth as it has just reported? No. Did we expect Zoom to grow revenues 2x what was expected coming into the year? No. So of course, there are plenty of things that have not been expected. But I think, Lee, but behind that answer, and with any surprise, I suppose, come a new set of challenges. And where my mind goes next relative to your question is a question that I think is more important for growth investors to consider than any other right now. And that is whether the global pandemic and the changes that have come with it has simply pulled forward the future. I mentioned the acceleration of some of the businesses the fundamentals that we invest in. So has the pandemic simply pulled forward the future such that the thesis for a company is that much closer to playing itself out? Or whether the pandemic and this acceleration has fundamentally changed the long-term opportunity for the better? It's a critical question given what has transpired in the past few months, and it's one that's informing what we're doing in the fund and the types of ideas we're looking for next.
In your fund literature, you say your fund is not driven by short-term trends, but do you think the sector is overheating? And if so, what is your current strategy?
Yeah, we construct our portfolio stock by stock. I think this is the best place to start. Stock by stock, case by case, bottom up. So that's to say we don't think much about the sector. But in the spirit of your question, what we do think about, if not the sector, is whether a particular holding has overheated. And by that, I mean whether the share price has extended beyond the fundamental opportunity, which would limit the future upside. And here our process has remained consistent, whether it's for a new position or an existing holding. We look at the current situation, the current opportunity, and consider whether there is still a good case to be made for significant returns from here. So to be specific, for the American Fund, our process, it's 2.5 times upside in 5 years at the bare minimum. Now, generally, because the companies we traffic in are early in disrupting very large markets and therefore have a very wide range of business outcomes, not just stock outcomes, but business outcomes, earnings trajectory, revenue trajectory, we tend not to sell just because a stock has done well of late, especially if fundamentals are strengthening. So said another way, on a typical valuation metric, which is usually either based on the recent past or the near-term future, a stock may seem outrageously expensive. But if the opportunity is great enough and you have a 5 to 10 year time horizon, there may still be ample room for upside.
Dave Bujnowski, Portfolio Manager at the Baillie Gifford American Fund. Thank you very much.
Thanks, Lee.